If Julia deposited $100 each month for 35 years into a 401k savings account, paying 3.99% annually, and her employer matches 100%, okay, first of all, if your employer matches 100%, you jump on that bandwagon. How much will Julia have contributed? Well, Julia, put in $100 a month. There are 12 months in a year, and she's been doing this for 35 years. So she's contributing $42,000 over the course of 35 years. What will her employer contribute? Well, 100% match means exactly the same. So her employer will also put in $42,000. What will her balance be at the end? Well, if you're trying to find the balance of a 401k plan, we're dealing with future value with an Excel function. So her interest rate is 3.99%, and I've got to divide that by 12 to make it monthly. Then I'll do 12 times 35, 12 months in a year, 35 years in the loan, and 200, because she's putting in 100 and the bank or the company's putting in 100. When you type that into Excel, just as you see it, it's going to spit out at you $182,356.76, right? So that's pretty nice. Now, how much did she earn in interest? Well, remember that interest is the total minus the deposits. So the total that we just found was $182,356.76. The total deposits is $84,000 because the deposits are Julia and the company. So when I subtract those, I get $98,356.76 cents. So nearly $100,000 in interest for Julia. Now we're going to do a little play game here. If Julia pays a tax rate of 20%, how much will her monthly tax savings be? And I find it hard to talk in an abstract, but I can talk concrete numbers. So I'm going to play a pretend game. And this works. No matter what number you pretend with, it works because we're talking about a rate. And a rate is worked off percentages, and so it doesn't matter what number we start with. So we're going to pretend that she grosses $1,000 a month. And I just picked $1,000 because it's a nice, easy number to play with. If her taxes are 20% and she makes so this first we're going to say no contribution, then the taxable income is $1,000. So $1,000 times 20% means she's going to pay $200 in taxes. Okay? So if she's still doing $1,000 a month for her gross. If she contributes $100 contribution, that means the taxable income is now only $900 because it's 1,000 minus 100. So if we take 900 times 20%, that's $180 that she's paying in tax. So her tax savings is 200 minus 180, which is $20. She will save $20 a month if she contributes $100 to her 401k. And again, you can try this with grossing $10,000 a month. That doesn't matter because the difference between the last two will always be $20. Okay, let's go on to the Smiths. The Smiths have just had a new baby daughter, Kennedy. They realize the importance of saving for college early, so they open a 529 account for their daughter. They plan to save $50 a month until she turns 18, so there's 18 years, earning 4% APR. So what are they going to type into Excel to figure out how much they'll have for Kennedy? Well, we're looking at a future value of an account. So APR divided by 12, 12 months in a year, and they're doing this for 18 years, and they're putting $50 in a month. If you type that in, so if you type that into Excel exactly like you see it, they will have $15,779.62 in the account at the end of 18 years. I just answered that question. So $15,779.62. Now, if they decide that's not enough, they can always put in more. But first, let's figure out, if they do this the way they have it planned, how much will they have deposited into this account? Well, $50 a month 12 months in a year for 18 years means they will have deposited $10,800. And that's not bad if they're getting a return of 15.7, right? They're earning, roughly $5,000. So, how much interest will they have earned exactly instead of rounding? So if they had 15,779.62 and they only deposited 10.8, that means the interest earned was $4,979.62. So in the $18, they're earning roughly $5,000, which depending on where their kid goes to school may or may not cover a semester. All right. Now, what if they decide they need more money? So let's put in $100. Well, we go back to our future value formula. 4% interest divided by 12. We're still doing 12 months in a year for 18 years, but now they're putting in $100. So if you type that into Excel, that will give you $31,559.24. So that's, more than double what they had in the same amount of time by putting in the $100 instead of the $50. So if they can afford it, it would be better for their kid. Well, their kid would appreciate it. All right, let's do a comparison of Kane and Albert in their retirement. So Albert saves $100 a month for 40 years, so that's Albert. $100 a month for 40 years. Kane waits 20 years and deposits $200 a month. They both have a 3.99% APR. So Albert's future value, we'll do Albert in orange, his future value, 0.0399 divided by 12. He's 12 months a year for 40 years, and he only put in $100 a month. When that happens, he will end up with $117,901.25. He contributed $100 a month, 12 months in a year, for 40 years, which was $48,000. His interest is the difference between those two, and if you subtract, he earned $69,901.25 in interest, more than doubled his investment of what he actually put in. Now, Kane, not quite as bright. He, still same interest, 3.99% divided by 12, but he only put money in for 20 years, but he did put in $200 at a time. So he ends up with $73,272.55. Quite a bit less at the end of their retirement times. He contributed $200 a month for 12 months in a year for 20 years, which is the same amount of $48,000 that Albert put in. You'll notice that when you subtract, his interest is $25,272.55. So they put in the same amount over the course of their retirement amounts, but because Albert's had more time to grow, it gained a whole lot more interest. So if we're going to write a ratio of Kane's interest to Albert's interest, so Kane earned $25,272.55 in interest compared to Albert's $69,901.25. Now that ratio means nothing when it's those kind of numbers, so let's go ahead and divide, and that will leave us with a 0.36 to 1. So Kane's on top, Albert's on the bottom. So what does this mean? This means that Kane earns 36 cents to Albert's $1. So every time Albert earns $1, Kane is earning 36 cents. That doesn't sound very fair, but Kane's the idiot, so that's what he gets. Last question of the video. How much did Kane lose by starting 20 years later? Well, since they put in the same amount, Albert earned $69,901.25 in interest, while Kane only earned $25,272.55. If we subtract, the difference between those is $44,628.70. So Albert earned an extra $44,000 and change based off of having the retirement plan started earlier. So the importance of starting early is that you're going to earn more in interest over the course of the time. So start early.